Hi, good evening, everybody. I think it's time to start. So we'll just make a move now. Welcome this evening, to our Singapore Credit Outlook seminar. My name is Timothy Ang, credit analyst of Phillip Securities Research, covering Asian corporate bonds. And together with me, we have the Bond Desk, Richmond, Andrew, Evelyn, and Wee Chai. And today we'll just cover an overview of the Singapore credit markets and the overall macro environment that is affecting markets today. And then we'll end off with a Q&A where we will help to answer your questions. So this is an overview of our outline today. We'll just cover the themes that are affecting the markets. We'll end off with some key bond picks, and then after that we'll answer some of your questions. So to assist us with answering questions, we'll be using this website. So www.pigeonhole.at, or you can just scan the QR code here and enter the passcode bonds. So here you'll be able to ask your questions, and you'll be able to vote for the questions that are most pressing to you. So you can answer those questions first. So just give you a moment to scan the QR code or to go to the website. Okay, so let's begin. Okay, so we are covering the Singapore credit markets. One of the big themes of the markets nowadays, right, is that yielding assets are in. Right, yielding assets are in. So yielding assets are, for example, corporate bonds or REITs, assets that pay you consistent returns, right? So the corporate bonds pay you coupon rates, or consistent coupons. REITs pay you consistent dividends, and these are the yielding assets that we can see that there's a lot of demand at the moment. The purpose for these kind of assets is really people buy it to beat inflation, or to generate a decent income on their cash, these kind of things. And so the reason why we are seeing that there's a surge in demand for yielding assets, right? Reason number one is that interest rates are at record lows, right? So the central banks have, especially the Federal Reserve, they've cut interest rates to 0%. We also see that Singapore rates have also at a historical low, right? All below 1%. In fact, we look at Japan and Germany, they've been paying negative interest rates for some time already. So that means for negative interest rates, it means that if you want to park the money with them, right, you have to actually pay them to park the money with them. So that doesn't really make any sense. So where all this money go? All these people have to find, all these people that that want to invest in yielding assets have to look for an alternative source to invest their money right now. All right, the government bonds are no longer an attractive source. So there's this big search for yield in the market for yielding assets, right? There's a big search for demand of demand for corporate bonds or for REITs, right? And this is not a short-term thing also, right? We're expecting this to last at least until 2022. So it's not really a short-term thing. So what we can see here in this chart is that it is the expectations for the Federal Reserve to raise their interest rates. Currently now the rate is between 1 to 0.25, between 0 to 0.25%. And you can see the dots. Those are the expectations that the interest rates levels are expected to stay at. And you can see the rates, their expectations only start increasing after 2022. So the interest rates, we're expecting it to remain lower for longer. And so that's why it's going to drive the demand for yielding assets over this period of time. Okay, and so the second reason why yielding assets are in right now is because we may be expecting a range bound market ahead. So the big driver of the market right now, as you all would know, maybe if you all read the news, is that the Federal Reserve is a big key driver of the markets right now, right? So ever since COVID-19 hit the markets, the Federal Reserve actually was the one that came in to rescue it. They pumped trillions of dollars into the market to prop it up, and they made a lot of promises to the market in order to help it to stabilize and to support it. Right. So, but what we're learning right now, recently, right, is that we're learning that the Federal Reserve's support, the central bank support, is conditional, meaning that what quoting Jerome Powell when he was talking to the Senate Banking Committee a few days ago, quoting him, if the market function continues to improve, then we're happy to slow or even stop the purchases, right? The purchases of bonds or stocks, or how the Federal Reserve is propping up the market. If it goes the other way, if the markets go too low, then they'll start to support it again, increase the support. So what they really mean is that they don't want to be in total control of the market. They don't want to drive the market so high until they'll just be the only demand in the market, but they want to taper it based on the market conditions, right? So what this means is that this is going to prevent the market from going too high, and it will support the market if it's going too low. In other words, we may expect a range bound market in the coming future. And so why yielding assets are good in a range bound market, right, is because regardless of whether the market is in a range bound, you still get your returns from the yielding assets, right? They'll still pay you your coupon rate, they'll still pay you your dividend yield, regardless of whether the market is flat or not. And so that's why there's a demand for it. This is another reason why yielding assets are quite in demand at the moment. So these two reasons, interest rates are low, and we may be experiencing a range bound market in the coming future based on the support from the Federal Reserve. So, but we know that demand is there. But the thing is that we know that bond markets have recovered also. So we note that there is a lower upside compared to previously when the prices were lower. So an indicator of this is the Thomson Reuters IH Corporate Bond Index for the Singapore market. And this tracks the corporate bond prices in Singapore corporate bond prices. And we can see that the prices have already are higher than their previous high already, since before COVID-19, right? So now you can't really say that it's cheap anymore, especially given that we're paying a higher price than before COVID-19, and the economic situation is you can say that it's worse than previously before COVID-19. So you can't really say that it's cheap anymore. But the thing is that the good thing about this is that the recovery in prices is on the back of recovering economic data as well. So it's not just the prices are moving without any economic backing, but it's happening alongside the economic recovery also. So as economies reopen, there's increased mobility. We see global PMIs recovering in a V shape. You're on and off the economy, and that's why you get a V shape kind of recovery thing. So because there is a recovering economic data, so it gives a potential for further upside, because you can see signs of recovery. So there's more potential upside. Okay. So further upside is probable, but it's uncertain because prices are a bit have recovered quite a lot already. So there's lower reward to risk, but we still do see further upside catalysts. So the first catalyst for an upside is is going to be a COVID-19 vaccine progress, or certain good news about COVID-19, right? Phase 3 opening earlier than expected for Singapore, or further economic data surprises like we got for the US macro data in May. The unemployment rate, it was expected to rise by 6 million, the unemployment rate in May, but ended up it actually decreased by 2 million. So the US economy actually added 2 million jobs rather than lost 6 million. So that's really a surprise that really drove the markets higher. But there's an indicator for surprises. It's called the Citigroup Economic Surprise Index. They actually they track the positive surprises in the market, and the level of surprise, the positivity that we have in the market in regards to surprises. And the thing that we have to note is that the more surprises we get, right, it becomes logically harder to get even more surprise because the markets tend to become more optimistic and have higher expectations. So this is what the chart shows, that we are really very positive at the moment, right? So the likelihood of surprises diminishes because the market, as the market experiences more surprises. So there's one upside. Now the second upside is Sing dollar appreciation. So if the Sing dollar appreciates, and is expected to appreciate, there's a high demand for Singapore investment assets, mainly because not only do you get the capital gains, the gains from the Singapore assets that you buy, but you also get the gains from the foreign exchange appreciation as well. So the catalyst for US dollar appreciation, a very big catalyst to drive a bigger move, is two things. So firstly is if the Federal Reserve starts this thing called yield curve control, and if the second thing is whether the Federal Reserve starts having negative interest rates. So, but these two things currently we see is quite unlikely. There's quite a lot of talk about it, but so far they've been saying that is still in the talks, and it's quite unlikely that they'll do it. But also because although these two things are unlikely, right, gradually we may see more Sing dollar appreciation also, mainly because Singapore asset values are still low in terms of book value, and our yield is pretty high compared to the other Asian countries around us. So that drives more demand for our assets, and it'll slowly reflect into the Sing dollar strength. So we may see a gradual strengthening of the Sing dollar moving forward, but no big catalyst for now at the moment. And so the last upside catalyst that we may see, right, is lower Singapore government bond yields. Okay, so back in May when I did a previous webinar, there was actually a point that I made about the Singapore government bond yields, and that they were quite attractive with regards to the US Treasury bond yields. So in the chart on the left, you can see that the Singapore government bond yield, the yield curve, is the blue line, whereas the US Treasury bond yield curve is the green line. So the yields of the Singapore government bond yields, the Singapore government bonds were pretty attractive compared to the US Treasury bonds. And as you can see, there's a quite a big difference, and it's quite attractive. But now after 1 month, and when in 19, the prices have compressed, and it's showing relatively lesser attractiveness, especially with regards to the shorter tenor bonds. So between the 1 year to the 5 years kind of period, you can see that there's a very drastic tightening of the Singapore government bond yields. The Singapore government bond yields have been dropping quite a lot for that short term, but they also drop for the medium term, right? So the attractiveness for Singapore government bond yields has been diminished. And so bottom line is that it's still a possibility that we may see a lower Singapore government bond yields moving forward, but chances of it is lower because the attractiveness of the yields is lower. So the main takeaway for the upsides, right, is that we can still expect these upsides to happen, right? But they're less certain because most of the things have recovered, right? Economic data surprises have been maybe harder to come by because we've really, the market is expecting more because of all the surprises we have. Sing dollar strength, the big catalyst, still unlikely at the moment. Then government bond yields dropping, making corporate bonds look more attractive. That one also is the probability is lower, is less than before because the attractiveness is lesser than before already. So there's still upside, but given that the markets have recovered, it's harder to predict. But what we can see in the upcoming months is that there's various risks that that can provide you with entry opportunities that can be more certain, right? We expect a more choppy market ahead because of various risks that we see in the horizon, right? The first risk is quite obvious. It's a second wave for COVID-19. So yes, we can see there's a lot of protests in the US. It's just a big driver for COVID-19 basically. There's no social distancing, and it's just the worst case scenario that they have during a pandemic, right? To have protests, and we can see that in the globally also we can see that daily new cases have been rising, although we see that developed markets have stabilized and are on the decline. Globally wise, we still see an increase, but developed markets we see a decline. But with the protests, there may be a worse than expected second wave that may happen, right? And we can see that not only that we have second waves, we can also see more shutdowns, right? Like China and Korea. China actually shut down their markets, and Korea they shut down a district also, I think, in recent news because of new clusters of cases, right? So these are opportunities, short-term opportunities for you to enter for entry. The second bigger risk, one that maybe might be harder to predict, is the US presidential elections. So the case for this is that on the chart on the right, you can see that this is the polls, right? It shows the probability of which side will win, the Democrats or the Republicans. And the Democrats are currently in the lead, 48.4% versus 40.4%. And soon we'll be starting to see more news about the election coming up because it's just in November, right? But with regards to the Democrats winning, right, it's not really a good tone for the market. The Democrats are different from Trump. Trump wants to keep taxes lower, right? He wants to keep taxes lower for all the corporations. But the Democrats want to raise taxes for the big corporations. They want to increase taxes on the rich, and they want to spend more on big social agendas like Black Lives Matter and repatriations of to repair all these bad things that they have done, to say they're sorry to all these kind of social groups and these kind of things. And this leads to more spending, to healthcare things, free health, universal healthcare. It leads to more spending, and in order to pay for all this spending, they have to increase taxes. And the higher spending is generally not so good for the economy, and I think that markets may not have been priced in yet this risk in the horizon. And the second risk is US-China trade tensions, of course. So the rhetoric for Trump is that his supporters are against China, right? So he's always China stealing our products and this kind of things. So his rhetoric is always anti-China. He wants to revoke the Hong Kong trade status of these China companies and these kind of things. And so he may step up this rhetoric as it goes. But the thing is that it's harder to predict now because China may want Trump to win. Right? They may think that Trump is good for them in a way, because in recent news they actually held up to their deal, the phase 1 deal. They actually bought the promised amount of soybeans from the US. Right? They're holding up the deal, and so they're saying that almost as if they're signaling that Trump has kept them under control. And that's and Trump is good basically in a way. So we may see either side of this, whether trade tensions may get better or trade tensions may get worse. We're not really sure about this. It's quite uncertain. But in a chop, this may give you better opportunities for entry, given the choppiness of this kind of news that we can get in the markets. Okay, and the last risk, this is the more of a medium-term risk, is the debt problems, because the central banks has spent a lot of money to prop up the economy and this kind of things, and in the future they may experience some trouble repaying the interest payments and their debt payments, or if they pump too much money in the economy, it may cause a currency devaluation as well. So these are the things that to keep in mind over the longer term horizon. So after looking at all these upsides and the downsides, our overall view on the Singapore credit markets and the overall global credit markets in general is a neutral stance, right? We can see that there's demand still there because there's lower yields and there may be a range-bound market, and yielding assets pay you a return regardless of whether a market is flat or not. But the thing is that prices have been largely recovered and there's more downside risk that we can see in the horizon. So we can see there's short-term entry points available. So overall, a neutral stance on the markets. Now that being said, right, even if it's harder to find valuable bonds since the prices have recovered, right? There are still valuable bonds available, as we'll cover later in our key bond picks. But before we go to that, just another theme that we have in the market. So perpetual bond non-core risk is another theme. So this non-core risk, I think many bondholders should know about this. So because there was a news about this Escort Residence Trust, they chose not to call their bond. They chose not to redeem their bond on the call date, and instead allowed it to extend further the tenor. So that means that current bondholders will receive a lower interest coupon rate for a longer time. And so they really set a precedent for this non-core risk moving forward for perpetual bonds. So just to give you a background, right? Perpetual bonds are bonds without maturity dates. So they only have call dates, meaning that the issuer has the option to not redeem your bond at the call date, but they can choose. They have the option to let it extend for a longer period of time. And there's a higher risk now for this non-core risk for issuers not to call their perpetual bonds because interest rates are lower. And many of these perpetual bonds, if the issuers don't call these bonds, they will have the bonds coupon rates will actually fall based on the current interest rate environment. So it's good for the issuer because they pay you a lower interest expense. So it's better for their balance sheet, but it's worse off for bondholders because you are left with a lower yield for a longer time. And so I just wanted to put this chart out there, this table, to show you how to mitigate this risk. And I put a list of bonds with step-up coupons here. So step-up coupons basically is something that will kick in if the bond is not called, right? So let's say, for example, the second bond, Singapore Post. So their call date is on the 22nd of the 2022, basically 2022. So if Singpost decides not to call the bond, decides not to redeem their perpetual bond at 2022 March, right? The coupon rate will actually increase by 150 basis points or 1.5%. So this discourages them from not calling the bond at the call date. So choosing perpetual bonds with this step up feature is one way to help you mitigate this non-call risk, this theme of non-call risk for perpetual bonds in the market at the moment. So all these bonds in this table have step up coupons on the same day as the call date. So if the issuer chooses not to call on the call date, then the coupon will step up by the step up rate. But there are other structures also for perpetual bonds, and these perpetual bonds have step up coupons also. But the thing is that their step up coupon dates are later than the call date. So for example, for the second bond, Wingtai Properties Finance, the 4.35%, the call date is in 2020 this year in August, but the step up coupon date is 10 years later. 7 years later than the call date. So 2027. So the bond will not step up if they don't call it this year. So the structure really matters when you choose the perpetual bond at the moment, right? So for this Wingtai bond, the structure is weaker than a perpetual bond that has a step up on the same day as the call date. So having a step up date that is later than the call date, it basically leaves you. It basically it keeps a higher non-call risk for the bonds still. So these structures for these perpetual bonds are weaker compared to the previous ones in the previous tables. All right. Okay, so on to our key bond picks. And the theme for our key bond picks in this environment is bettered but with strong backers, right? Like issuers with strong stakeholders. Issuers that have attractive bond yields that have strong stakeholders, because they give you better reward to risk. You enjoy the higher yields that you get, and you get the strong stakeholders that have strong backing to your bonds. So why strong stakeholders matter, right? I think we experienced the importance of strong stakeholders during this COVID environment. So examples of stakeholders can be owners, shareholders, bondholders, or even governments. And the benefits that it can give to you as a bondholder or to the issuer is a business support and financial support. So in the case of Temasek, they stepped in to save Sembcorp Marine, they stepped in to save SIA, and Olam in the past when they had refinancing concerns, and they stepped up to support Keppel Corp as well. So having a strong sponsor stakeholder for your issuer provides additional business support and additional financial support that the company can rely on, especially during difficult times, financial times. So in this table on the right, we can see the list of issuers that Temasek has a stake in. But the thing about these issuers is that the yields are lower for these bonds, for these issuers, because people understand the part that Temasek plays in them, right? Temasek has a supporting role in this. That's why the bonds are priced at a cheaper price. So what we're looking for is we pick bonds with big established stakeholders that shows attractive yields for retail investors. So the first issuer we'll look at is Guacoland. This is a luxury residential property developer, mostly property development in Singapore. It's more than 60% owned by Hong Leong Group. And Hong Leong Group owns Hong Leong Bank. Right? Hong Leong Group is a big conglomerate in Malaysia. It owns Hong Leong Bank, which is the 5th largest bank in Malaysia. And this relationship opens access to sources of funding, right? Having a very strong relationship to a bank that actually owns your company gives you very strong sources of funding. Hong Leong Group controls over 14 listed companies and owns over 300 companies and is listed in 5 different countries. And these two people you're seeing, the Quek family, Hong Leong Group was founded by this guy on the right called Quek Ling Chan. He's the CEO of Hong Leong Group and is one of the richest men in Malaysia. Whereas Quek Hong Peng is the executive chairman of Hong Leong Group, one of the richest men in Singapore. So you can see that there is a strong established backing to Guoco Land behind it. And looking at and why we like Guoco Land also for its credit profile. For the credit view for Guoco Land, we can see that we like it for its strong short-term liquidity after selling off its hotel in Shanghai. So it sold off its hotel Guomen hotel in Shanghai for a net gain of 90.6 million. And they also successfully issued 200 million Sing dollars worth of bonds in February before COVID-19 hit. So what this gave them is it gave them enough cash to pay off all their short-term debt by 1.5 times. So there's really a healthy short-term liquidity that they have right now. And if looking at their interest coverage ratio of 2.3 times, although we know that luxury residential property sales will decline during this COVID situation because foreign investors are not allowed to enter the country. But you can see that it's quite a manageable buffer of 2.3 times interest coverage and a debt headroom of more than 2 times, meaning that they can increase their debt by 2 times and still be within their debt covenants. So it provides a big buffer to ride through this downturn. So for this issuer, we don't really see much in these issuers. They have multiple bonds, but the one that we see most value in is their 4.6% perpetual with a call date on the 2023 with a yield towards of 4.39%. This bond has a step up of 1% at 2025. Okay, the next issuer we'll look at is ESR Cayman Limited. It's one of the APEC's biggest logistics property developer and fund manager. And they're also sponsor of ESR REIT and Savannah REIT. So this company is actually backed by 3 players, 3 very big players. Warburg Pincus is one, the first one. So it's a New York-based private equity growth investor with 62 billion assets under management. The second backer is JD.com, one of the 2 massive online retailers in China. And the thing about JD is that it is also a tenant of ESR Cayman. So they use a lot of ESR Cayman's logistics properties. So there's an alignment of interest. We see a strong alignment of interest between stakeholder and company. And the last backer is SK Holdings. Is the 3rd largest chaebol in South Korea. So this chaebol is actually a large conglomerate in South Korea that actually plays a big part in their economy. So they own a large chunk of a lot of the companies in the economy in South Korea. And we also note that senior management owns about 22.6% of ESR shares. So there's a strong alignment of company and management as well. So there's a strong alignment of interest. What we like about this ESR Cayman is that e-commerce is a growth play. But although it's a growth play, we expect their debt to increase. But we can see that there's a strong short-term liquidity as well, because ESR Cayman was listed previously last year in October 2019 and successfully raised $1.8 billion in the IPO. So currently now, their cash to short-term debt is more than 2.5 times. So they have enough cash to pay off their short-term debt by 2.5 times, and that's a very healthy short-term liquidity. So two of their bonds are quite attractive in our view. So the 6.75% maturity date in 2022 with a yield to maturity of 4.86%, and the 5.1% maturing in 2025, yield to maturity 5.151%. Okay, and the last issuer that we'll cover is Frasers Property Limited. It's a multinational property developer and owner. They own multiple REITs in Singapore, listed REITs such as Frasers Logistics and Industrial Trust and Frasers Hospitality Trust. And they are 87% owned by TCC Group. TCC Group is owned by the Sirivathana Bagni family in Thailand. It's actually the third richest family in Thailand. So, and they're the third largest property developer in Thailand. And TCC is also a conglomerate, so it's a very big conglomerate in Thailand. They own F&N, they own Thai Bev, which is the owner of Chang Beer, and they own this hypermarket chain called Big C in Thailand, and many other companies. So this is the family that owns TCC Group that backs Frasers Property Limited. So what we like about this company, the company's credit profile, we also see there's a strong cash flow visibility. So because they are a property developer, they have pre-sold revenues of about 1.3 billion for their property development. So this cash flow provides visibility to their to their cash in the incoming cash for the next approximately 9 months. And also 80%, more than 80% of their property assets generate recurring income. So that means more consistent income, recurring, less lumpy cash flows, and more visible cash income. So it's less lumpy, it's more predictable. The bond that we like, this Frasers Property Limited has many bonds, but the bond that we see that has most value is their 2026 bond, with a yield to maturity of 3.68%. And so these are the three companies that we're looking at. The three companies that have strong, the bonds that are still showing relatively attractive yields and have strong backers. So this is the theme that that we are seeing right now with regards to bonds in the market. Other bonds we're looking at right now is on this list. We try to pick those bonds that are above 3% because we as retail investors, we're really fighting against inflation rather than interest rates. So, and we know that consumer prices really fall, right? Other than unlike interest rates. So we try to look for decent yields, roughly more than 3% for retail investors to look at. So these are the bonds that we're still monitoring, the bullet bonds that we're monitoring at the moment. Okay. So in conclusion, for our key bond picks, it's harder to find decent yields in recovered markets at the moment, right? It's a really low yielding market now because prices are above previous highs. So that's why we're looking for a higher reward to risk ratio by looking at bonds that have attractive yields but with strong backers. So we can get a better return while having a better risk because of the strong backers. A lower risk because we know that there's financial and business supports that the backers have for the company. Okay, and this brings us to the end of our presentation. So we'll just now do the Q&A, and you may write your questions, and you may vote for your questions here at pigeonhole.at, and the passcode is bonds. Okay, so we will just answer the first question. Personally, I'm pretty cautious because of COVID-19 measures. Are there certain sectors which are positive? Yes, there is. So there are many REITs that are actually benefiting from these COVID-19 measures, like the industrial REITs, because industrial REITs are more sticky with their tenants. They're more sticky with their tenants because the buildings, right? The industrial REITs, it's not easy to just move away from these buildings because they're specially built for these companies. So it's more sticky tenants, these kind of things. Then we can see, Temasek-backed companies as well. These companies are still remaining positive in this current climate. Certain sectors that are positive will be the consumer sector, but those bonds are really priced really low, maybe about low 2% plus. That's why it may not be attractive to retail investors in a general sense. Okay, next question. Do you think Fed will raise interest rate to support the USD if markets dump USD? So the problem with the Fed is that if they raise interest rates, they may not be able to pay off their debt, right? Because they issued so much debt, and they have to pay off the interest on this debt. So if they raise interest rates, it's not going to be good for them. It's probably going to stress their ability to pay off the debts and the interest payments. So they're really stuck in a hard spot where they can't raise interest rates, and if the market dumps the USD, then if the market dumps the USD, then they may not have any options to. They may not have the option to actually raise interest rates, but we'll see. Okay, since interest rates are low, is it advisable to leverage on bond investment? What is the spread we should seek? Yes. So interest rates are low. Yeah, you can actually take advantage of margin financing, which we provide. So you can talk to our bond desk to look about our rates. The spread depends on the margin financing rate that we offer. So you want a yield that pays higher than the financing cost that you're paying, but generally you want higher than 3%. Okay, are perpetual bonds still good to invest? If so, what are your recommendations? Yes, you have to pick the right ones. So previously I showed a table for the perpetual bonds that have favorable structures. So they have step-up coupons on the same day as the call date. So those are the ones that have lower non-call risk. You can drop us an email at bonds@phillip.com.sg, and we can send you the report for those perpetual bonds that have better structures. Okay, next. You mentioned that yielding instruments are bonds and REITs. Should an investor look at REITs rather than bonds? It's really your preference. So for REITs, yes, you get a higher dividend yield, but the thing is that your principal is not guaranteed. I mean, your principal is not promised. So that's the thing, and so you may get your yield, and the thing is that a lot of these REITs nowadays, they're also cutting their dividend yields also. So it's not as stable. It's not as, I would say, promised as bonds. So it's really your preference as an investor whether or not you want a yielding instrument that promises more or less. But yes, the REITs do look attractive at the moment as well. About Wingtai 4.48% perpetual corp SGD, price has not been fully recovered. is a corporate bond. What's your advice? Okay, let me have a look at the. Okay, the 4.48% perpetual bond has a good structure because the step up and the call date is both on the same date. So it is a good structured bond that we can see that I think will maintain its demand until its call date. So if you are willing, you can hold it until its call date. I would recommend that you hold it until its call date, because right now your price has not been fully recovered as well. So given that it has a lower non-call risk, you can just hold it until its call date, and there's a lower chance that the company won't call it. There's a lower chance that of non-call risk for this bond. So this is a good structured bond, a good structured perpetual bond. Okay, while bonds have backings from sponsors, how do we ensure our current bond holdings do not end up like HiFlux, which had strong backing? Okay, so HiFlux is different. Temasek actually pulled out of HiFlux, right? They pulled out of HiFlux, I think 1 year before, before the whole thing just before all the news just came out, that all the problems came out. So that's the thing about having strong sponsors. Okay, so not only do you have to consider that these sponsors can actually divest from the companies, right? But that another thing is that sponsors can also, they may not remain strong. So you have to pick carefully, and it's not really 100% guaranteed that the sponsor will help. There's no sure thing in the market, right? But having that strong sponsor really helps with regards to having a financial backing and having some business support as well. Okay, how are perpetual bonds ranked in times of restructuring, equity or debt? They're ranked as equity. So they're ranked lower than debt. So when a company goes under restructuring, the debt holders will get paid first, then the perpetual bond holders, then the shareholders. What does YTM mean? YTM stands for yield to maturity. So that's the return, the annual return that you get from the bond if you hold it until maturity and get back your principal at maturity date. How do we get access to new bond issue? Okay, hold on. Okay, new bond issues, you have to talk to you have to call our bond desk so that we can include you in the list, an email list or an update list, so that we can update you on when a bond issue is coming up, or whether there's a bond issue on the day. And then by subscribing for a bond issue is as simple as contacting your financial advisor or our bond desk directly. So our contact information, I'll put it in the chat here. Okay, I heard that interest rates will rise to 4% historical average because it has remained low for too long. Do you think so? There's a lot of risk involved when raising interest rates until too high. The main risk is that, because the debt levels of the central banks are too high, so they may actually struggle to pay off debts if the interest rate is too high. So, but the thing is that it it may actually have to come. Higher interest rates may have to come because if inflation goes too high, then the central bank has to raise interest rates so that it can moderate inflation. So it's really a tight spot for the central banks. Whether or not they want to raise interest rate or not, I'm not going to predict whether they are going to raise it or not. But but we have to see how they handle, because now it's really a unprecedented time when the debt levels of central banks are so high. So they really have to take into consideration when they can raise the interest rates. Okay, bonds should go down when equity goes up and vice versa. My bond holdings dropped in value during the COVID crisis. Why is this so? Okay, no, bonds, when you're talking about bonds should go down when equity goes up. Uh, this generally works more for government bonds rather than corporate bonds. So government bonds are considered, the risk-free bonds in the market. So when the economy drops a lot, then the bonds, there's a lot more demand for the risk-free bonds because there's a flight for safety. So there's an inverse relationship between government bonds and equity. But if you're looking at corporate bonds, it's more of a hedge to volatility. So corporate bonds were still, they're still pegged to the same company as the stock. All right. So if the economy is not good for the company, then yes, it will affect the credit profile for the company, and the corporate bond prices will drop. But they will generally drop less than equity because they are ranked higher than equity, and they have more contractual promises than equity. Okay, rule of thumb, what are some of the ratios which you look at to access issuer profiles? Interest coverage, gearing, cash flow, etc. Do you look at these? Yes, we look at these ratios: interest coverage, gearing, cash flow. So we look at the future levels of these ratios to determine whether they will improve or not, or whether they can actually help to maintain the company moving forward, whether they're able to pay off their interest, whether they're able to pay off the debt, and whether or not that they have enough cash flows to maintain their operations and these kind of things. So generally speaking, yes, we look at all these ratios. Do you always have a list of bonds that is recommended? Where is this list? Okay, so this we post out a few reports regularly, but we don't maintain a list. So if you want a list of bonds, because the prices move, and sometimes some of these bonds will be, other bonds will become more attractive and other bonds will become less attractive. So if you want a more up-to-date list, you can just drop us an email, and we'll send you a list of the bonds that we find attractive at the moment. Okay, you mentioned prices have recovered. Will it be better to wait for the next crash? Okay, we may not be able to predict when is the next crash, right? But we know that there's events that will make the markets more volatile in the coming future. So that's all we know. We won't know whether there'll be another crash or not. So so I would rather say that better not to wait for the next crash, but to be invested in the market as it goes along, right? So that you don't lose any opportunity cost. Okay, and we'll take one more question before we end this webinar. Okay, the last question: for issuers with government link, for example, Mapletree Capital and Asunders, do you think yields around mid 2% is within benchmark of 5 to 6 years maturity? Worth investing in these? So yeah, many of their bonds are within this 2% range. for these government-linked bonds. So usually when we're talking about these low-yielding bonds for investment grade, right? It's more popular. It's more taken up by the institutions rather than the retail investors, because the financing rate is, if you want to finance on these bonds, right? The financing rate is very close to the yield that you're getting already. So there is not much there's not much spread. There's not much returns that you can get from these bonds as a retail investor. Not that attractive. And once again, we're not fighting against the interest rates. We're fighting against inflation. And so 2% is not really a good hedge against inflation. Maybe more along the lines of above 3% would be more attractive. Okay, so I'll just flash out our contact details here again. So for those of you that want to get in touch with us, this here is a QR code to open a trading account, and the QR code to receive to register for our email updates, so that you can get regular bond updates such as new issues that come out in the market. So our contact number for the Bond Desk 6212-1818, and our email bonds@phillip.com.sg. You can contact us for any inquiries with regards to bonds